When you sell an investment for more than you paid, the IRS wants a piece of that profit. Here is how capital gains taxes work. At its core, this tax is simply a levy on the profit you realize when you sell an asset that has increased in value. The math starts by subtracting your original cost, known as the cost basis, from the final sale price of your asset. The IRS categorizes your gains based on time. Holding an investment for over a year usually unlocks more favorable tax treatment. Comparing the two shows why long-term investing is generally more tax-efficient for the average retail investor. Long-term rates are tiered based on your total income, but they are consistently lower than standard income tax brackets. Savvy investors sometimes use losses from one investment to lower the total tax bill on the gains from another. Tax laws change frequently, so consult a tax professional regarding your specific situation. Thanks for watching and stay informed.